Let's talk about something that happened last week that barely made a splash in your daily news feed, but is genuinely one of the most important economic events of the year. On June 11th, the European Central Bank raised interest rates for the first time since September 2023. That's nearly 3 years without a single rate hike. And then, boom, 25 basis points. Deposit facility up to 2.25%, main refinancing rate up to 2.4%. Marginal lending facility to 2.65%. And the reason why is a word you've been feeling at the pump, in your grocery bill and in your utility costs. Energy. Here's the headline number that matters. Eurozone inflation hit 3.2% in May. That's the highest reading since September 2023. Energy prices alone are up 10.9% year over year. But here's the kicker. This isn't just a European problem. The US Consumer Price Index hit 4.2% annual inflation in May. That's a 3-year high. Gasoline prices alone are up 40.5% over the last 12 months. 40.5%. Your gas bill has gotten nearly 50% more expensive in a year. And it's not just gas. Diesel is up 47%. Jet fuel costs have soared so high that airline fares jumped over 20% compared to last year. Food inflation is at 3.1%. Electric utilities up 5.9%. There is nowhere to hide. So what is driving all of this? And here's where the geography lesson comes in. The Strait of Hormuz is a narrow waterway between the Persian Gulf and the Gulf of Oman, just 21 miles wide at its narrowest point. Before this year, about 20% of the world's oil and liquefied natural gas flowed through that strait every single day. That's roughly 17 million barrels of oil per day. Since the US-Iran war began in late February, the Strait of Hormuz is effectively closed. Ships can't get insurance. Seafarers won't make the journey. Even vessels willing to risk it face attacks from drones and missile boats. The result is that global oil supply has lost roughly 4 to 5 million barrels per day from the conflict, and that number could double. Even if a ceasefire holds, and that's a very fragile if, it will take months for the oil market to normalize. Damaged infrastructure has to be repaired. Stopped production has to restart. Vessels have to be repositioned. Commercial inventories have to be rebuilt. There's no fast-forward button here. Paul Krugman, the Nobel Prize-winning economist, warned recently that oil could hit $150 a barrel if the strait remains closed, and $200 is not out of the question. Brent crude is already trading above $90. Pre-war, it was around $75. The result is that the global economy is facing something it hasn't dealt with in decades, a coordinated energy supply shock hitting every major economy simultaneously, and central banks are scrambling to respond. The ECB was the first major central bank to actually hike in response. Let me quote directly from their statement. The war in the Middle East is generating inflation pressures, and the decision to raise rates is robust across a range of scenarios. That's a remarkable thing for a central bank to say. They're not hoping inflation will pass. They're acting on it. ECB President Christine Lagarde was asked if this was an insurance policy hike, and she said no, it's just good monetary policy. When you have inflation at 3.2%, with projections showing it peaking above 3% and staying over target through 2027, you raise rates. Period. The Fed, under new chair Kevin Warsh, held rates steady at 3.5 to 3.75% at its June meeting. But here's what's telling. Markets are now pricing in roughly a 50% probability of a Fed rate hike by September. Think about that for a moment. We spent all of 2024 and 2025 talking about rate cuts, lower rates coming, the soft landing, the pivot. Now we're talking about hikes again. Cleveland Fed. President Beth Hammack gave a speech saying she's worried about persistently elevated inflation. The Dallas Fed published a working paper estimating the war could add between 0.6 and 1.8 percentage points to headline inflation, depending on how long the strait stays closed. That is not a rounding error. And here's the part that matters most to your wallet, very directly. Moody's Analytics ran the numbers and found that the average American household has spent an extra $447 on energy costs since the war started. That's nearly $60 billion total, sucked out of the economy and into higher gas prices, diesel and jet fuel. And here's the brutal math. That $447 more than erased the benefit of the tax cuts from the so-called Big Beautiful Bill that passed earlier this year. The tax cut gave the average household about $384. The energy shock took $447. The net effect is negative. You are worse off. The personal savings rate tells the story. American savings rate dropped to 2.6% in April. That's one of the lowest readings since the global financial crisis in 2008. During the pandemic, the savings rate peaked at over 31%. Now it's 2.6%. People are burning through their stimulus leftovers, their rainy day funds, just to keep up with higher prices. The Bureau of Economic Analysis data shows real disposable personal income adjusted for inflation, actually fell 0.5% in April alone. Your paycheck is shrinking in real terms. You are spending more to get the same stuff. And this connects directly to the debt story we covered a few episodes ago. Remember the one about $1.25 trillion in credit card debt and 13% delinquency rates? That was before energy prices went parabolic. Higher gas prices mean more people putting groceries and essentials on credit cards. At average APRs of 22 to 28%, that debt compounds destructively. Minimum payments barely touch the principal. The debt spiral that was already in motion before the war is accelerating because of it. Your investments are also in the crosshairs. This environment is what economists call stagflationary, rising prices and slowing growth at the same time. The ECB's own projections show Eurozone growth at just 0.8% in 2026. The Fed's Beige Book describes a two-speed economy where AI infrastructure and services are booming while regular consumer spending stalls. For your portfolio, this is one of the toughest environments. Traditional 60-40 portfolios struggle when both stocks and bonds get hit by inflation fears simultaneously. We saw this in 2022. The 60-40 had its worst year in decades. If the Fed ends up hiking into a slowing economy, we could see a repeat. So here's the practical playbook. 5 steps you can take right now. Step 1. Inflation-proof your emergency fund. If you have cash sitting in a savings account earning 0.45%, and many people still do, you are losing nearly 4% real purchasing power every year on that money. Move it to a high-yield savings account or a money market fund. Some are still paying over 4%. Don't leave free money on the table when inflation is eating your savings alive. Step 2. Check your bond exposure. If you own long-duration bond funds with maturities over 10 years, you are exposed to significant interest rate risk if the Fed has to hike again. The 10-year Treasury is at about 5%. If the Fed raises rates, that could push yields higher and long bond prices would fall. Consider short-duration bond funds. Tips: Treasury inflation-protected securities, or Series 1 savings bonds, which adjust with inflation. Step 3. Diversify into real assets. Commodities, energy stocks, infrastructure, and real estate all tend to perform reasonably well during energy-driven inflation. Not because they're magic, because the goods they produce are the very things getting more expensive. Energy stocks have pricing power when oil is at $100 a barrel. Infrastructure companies can raise prices with inflation. That's just math, not speculation. Step 4. Pay down variable rate debt. If you have credit card debt, HELOCs, or private student loans with variable rates, make paying those down your #1 priority right now. The ECB just showed us that central banks can and will hike rates to fight energy inflation. If the Fed follows, your variable rate debt gets more expensive with every hike. The time to act is before the hike, not after. Step 5. Don't panic. This is the hardest one, but the most important. The economy has survived energy shocks before. In 1973, oil prices quadrupled. In 1979, they doubled. And then, over time, the world adapted. Cars got more efficient. Alternative energy sources were developed. Supply chains rerouted. The same thing is happening now, faster than most people realize. US domestic oil production, already the highest in the world, is being pushed higher. EV adoption continues to grow. The energy transition didn't stop because of the war. In many ways, it accelerated. The big lesson from the last century of financial history is that energy shocks are painful. They're disruptive. They reshape economies, but they eventually resolve. The question is whether you position yourself so that you survive the pain and benefit from the resolution. Here's what I'd tell a friend. Build your cash buffer. Shorten your bond duration. Pay down expensive debt. Own some assets that benefit from higher energy prices. And most importantly, keep investing consistently through the noise. Dollar-cost averaging into a diversified portfolio. Broad market index funds, some international exposure, a small tilt toward value and energy, has worked through every crisis in modern history. Including oil shocks, including wars, including inflation scares, including ECB rate hikes on a Thursday afternoon in June. The ECB's decision is a signal. It's the first crack in the peak rates are behind us narrative that dominated markets through 2025. But it's also a reminder that the global financial system is designed to absorb shocks and adapt. Your job is not to predict the next crisis. Your job is to build a financial life resilient enough to withstand whatever comes next. I'm James, and this has been Wealth Unlocked. Stay smart with your money, and I'll see you in the next one.